Have you ever pondered the ideal trading approach for reversals? Since they are simple to implement, trend-following concepts are the foundation of the most widely used strategies. Reversals are typically traded by more seasoned dealers. However, if you use the proper strategy and tools to help you make informed trades that result in a high win rate, predicting when a reversal will occur isn't difficult. So, in today's film, we'll demonstrate a simple yet effective method for spotting reversals and profiting from them. Let's get started now that we have cleared that up. The mean reversal is one of the various kinds of reversals. It is also one of the most frequent types. A mean reversal hypothesis contends that the price will eventually revert to its average. We can see that at these locations, this happens. When we look for patterns, we'll notice that whenever the price diverges from the average and the divergence is at its greatest, the price reverses course and returns to the average. We'll apply a moving average to the chart to determine the price's mean or average. Look for the moving average indicator under the indicator search option. Choose the TradingView created moving average indicator and add it to the screen. Go to the indicator settings and select the inputs page at this time. The indicator's duration will be increased to 50. Click on the style options after that. To improve visibility, the line's hue and thickness will be altered. A fresh pattern can be seen on the screen if we take another look. The price reverses and bounces back to the moving average whenever the distance between the price and the 50-period simple moving average is at its widest. Here, we see this occurring once more. The price reverses back to the moving average as soon as the difference between the price and the moving average is the greatest it has ever been. This leads us to the conclusion that the price will always revert to the moving average, regardless of how wide the gap is. However, by using only the moving average indicator, an issue can be found right away. The precise moment at which the price will reverse course cannot be predicted. The price continued to rise after this moment before making the reversal, but as you can see, the distance between the moving average and the price had already reached its greatest value. We will need to change the indicator on the display in order to correct this. Look for the Ballinger Bands indicator under the indicator search option. Choose the TradingView indicator, then add it to the screen. The following are the components of the Ballinger Band gauge: a middle-placed moving average, an upper band, and a lower band. The standard deviation option is visible if we navigate to the Ballinger Band settings. The value of the upper and lower bands is defined using this setting. Except for the length, we'll leave all of the input options alone. The duration will be changed from 20 to 89 according to the Fibonacci sequence. Navigate to the style options after that. To make the lines more visible, we'll modify their hue and thickness. That was all there was to it. Let's look at the indicators intended use right now. The linear regression indicator we earlier showed is comparable to the Ballinger Bands. This is because the price frequently resides in the middle of the rings. However, a reversal is possible whenever the price crosses through the upper or lower range. The Ballinger Bands will therefore aid us in deciding whether the distance between the price and the moving average is sufficient for us to take the trade. Let's examine an illustration of this. The price has closed above the top Ballinger Band, as you can see. As a result, we will take a short position. The recent swing high will serve as our stop loss, and the moving average line in the middle will serve as our take profit objective. Let's now watch to see how the deal turns out. As can be seen, the price closed below the lower Ballinger Band in this instance. This suggests that the market may change direction and return to the moving average. On the basis of this, we will take a purchase position. The recent swing low will serve as our stop loss, and the moving average line in the middle will serve as our take profit objective. Let's now watch to see how the deal turns out. As you can see, both trades are very lucrative, but even with the use of Ballinger Bands, there are still a lot of erroneous entries being made. We will add the second and final indicator to the chart in order to prevent these erroneous messages. Look for the RSI indicator under the indicator search option. Choose the TradingView indicator and add it to the screen. Go to the RSI indicator options and select the Style tab at this time. The RSI moving average and the backdrop fill will first be unchecked. The line's hues will then be changed to improve their visibility. That was all there was to it. The RSI is commonly used as a straightforward sign for buying and selling. They will sell when the RSI is overbought and purchase when the RSI is oversold. Although this occasionally serves as an additional proof, one of the indicator's most potent applications goes unutilized. Divergences can easily be detected using the RSI gauge. Let me give you an illustration so that you can better comprehend what a divergence is. Divergence is characterized whenever the asset's price is moving in the opposite way of the RSI. Here, we can observe that the price is rising and reaching higher highs. However, the RSI gauge shows that it is creating lower highs. A bearish split has occurred. We will take a sell stake as a result of this. As you can see, the transaction would have been very successful if we had taken a sell position. Now that you completely comprehend how the indicators will be used, let's look at the complete strategy that uses these indicators in combination. First, let's examine the best time to open a purchase position. When the price closes below the lower Ballinger Band, we will open a purchase position. We'll check the RSI indicator to see if the approach was accurate. In order for there to be a bullish divergence, the price must produce lower lows while the RSI creates higher lows. This is the situation, as you can see here. We will take the position because both requirements have been fulfilled. The most recent swing bottom will serve as our stop loss. Making sure that the risk-to-reward ratio is at least 1.5, we will aim for the center line, which represents the moving average, for the take profit. Let's now watch to see how the deal turns out. The following prerequisites must be satisfied for a sell stance to be taken. First, the price must finish above the upper Ballinger Band, signifying a wide discrepancy between the price and the moving average. Once we are certain that is the case, we will check the RSI indicator for proof. There must be a negative divergence for this to occur. When the price hits higher highs while the RSI gauge hits lower highs, this is known as a bearish divergence. This is the situation, as you can see. We will take the sell position because all of the requirements have been fulfilled. The most recent swing high will serve as the limit loss point. Making sure that the risk-to-reward ratio is at least 1.5, we will aim for the middle moving average line as our take profit objective. Let's now watch to see how the deal turns out. As you can see, the transaction was extremely successful. If you want to see one of my other trading strategies I use when day trading, check this video right here, because this strategy works great on the every time frame you want. I'll see you guys next time.